Good day, everyone. We are the Group 3. Now, we will tackle about risk associated with trading derivatives. But first, let's talk about what derivative is. What is a derivative? Now, the term derivative refers to a type of financial contract whose value is dependent on underlying asset, group of assets, or benchmark. A derivative is set between two or more parties that can trade on an exchange or over the counter or the OTC. So these contracts can be used to trade any number of assets and carry their own risk. Prices for derivatives derive from fluctuations in the underlying asset. These financial securities are commonly used to access certain markets and may be traded to hedge against risk. Derivatives can be used to either mitigate risk or assume risk with the expectation of commensurate reward. Derivatives can move risk from the risk averse to the risk seekers.
The third one is risk involved in trading derivatives. So there are four risks involved in trading derivatives. First risk is the market risk, so where the market risk that arises from movements in stock prices, interest rates, exchange rates, and commodity prices. Derivatives are also subject to market risk. So market risk or risk due to unfavorable movements in the level or volatility of market prices. Market risk result from the exposure to changes in the prices of the underlying cash instrument and changes in the interest rates. Market risk is the risk of the losses on financial investments caused by adverse prices movements. Example of it is the market risk are changes in equity prices or commodity prices, interest rates moves, or foreign exchange fluctuations. Four types of market risk. The most common types of market risk include interest rate risk, equity risk, commodity risk, and currency risk. So there are also three types of risk. Widely risk can be classified into three types: business risk, non-business risk, and the financial risk.
Good day, everyone. Before I start, let me introduce myself. I am Giselle J. Biagudu, and let's proceed to my topic, the counterparty risk. The counterparty risk is the risk of one or more parties in financial transaction defaulting on or otherwise failing to meet their obligation on that trade is referred to as counterparty risk. Counterparty risk is particularly important in derivatives markets where national values can far outstrip the size of the underlying securities. The risk associated with the other party to a financial contract failing to meet its obligation is known as counterparty risk. Every derivative tried requires a counterparty to the opposing side. Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transaction. All financial transaction involve some degree of counterparty risk. Counterparty risk is also referred to as default risk. The risk of default is the possibility that a company or individual will be unable to make the required payments on their debt obligation. Almost all types of credit extension expose lenders and investors to default risk. When evaluating a contract, both parties should consider counterparty risk.
Definition of liquidity risk. Liquidity risk is defined as the risk of incurring losses resulting from the inability to meet payment obligation in a timely manner when they become due or from being unable to do so as sustainable cost. The CEV aims at maintaining an appropriate level of liquidity, allowing it to meet payment obligations and support its operations during period of market disruption where funding becomes inadmissible. An important element of the liquidity risk management is the bank's funding strategy, which aims to avoid any significant gap between the maturity profile of assets and liabilities and to diversify the debit insurance programmers, funding markets, and the investors base. The bank also ensures that it holds a liquidity in reserves composed of highly liquid securities whose market value and liquidity would be preserved during adverse market conditions. The CEB measured liquidity risk using internal metrics and regulatory indicators complemented by qualitative analysis in line with base EU regulation. The main indicator used to measure the liquidity risk is the survival horizon. This metric measures the period during which the bank is able to fulfill its payment obligation stemming from ongoing business operation using its liquid asset and under a stress scenario. They include unavailability of new funding resource, erosions in the value of liquid asset, and contingent collateral requirements on the derivative portfolio. The bank also ensures that it fulfills the quality coverage ratio (LCR) and net stable funding ratio (SPCP). Liquidity risk does not define on your net worth. One very simple liquidity risk example is when a business has millions of dollars tied up in cutting edge equipment but not enough liquid asset to pay their staff or suppliers. The simplest way to lower liquidity risk is to always hold sufficient cash to meet demand. However, this is not optimal when organizations seek to make a profit or expand operation. In the financial market, liquidity refers to how quickly an investment can be sold without negatively impacting its price. The more liquid an investment is, the more quickly it can be sold, and vice versa. And the easier it is to sell it for fair value or current market. The value, all is else being equal, more liquid asset trade at a premium and liquid asset trade at its discount. In accounting and financial analysis, in company liquidity is a measure of how easily it can meet its short-term financial obligation. The banking of market liquidity example is how to many common investment are typically rate terms on how quickly and easy they can be turned into cash of course. The other order may be different depending on the circumstances. Liquidity ranking is is cash, foreign currency, guaranteed investment, government bonds, corporate bonds, stock, commodities, real estate.
Good day. So I will discuss the interconnection risk. It means that refers to how the interconnections between various derivative instruments and dealers might affect an investor's particular derivative trade. Some analysts express concern over the possibility that problems with just one party in the derivatives market, such as a major bank that acts as a dealer, might lead to a chain reaction or snowball effect that threatens the stability of financial market overall.
Conclusion or recommendations on derivatives. So in general, it is best to avoid trading derivatives unless you have a thorough understanding of the risk involved. These financial instruments can be highly complex and volatile, making them difficult for individual investors to manage. Before trading derivatives, it is important to carefully research the market and consult with a financial advisor to determine whether or it's not a good idea for you. Even if you decide to trade derivatives, it is crucial to carefully manage your risk and avoid overexposure to these instruments.